Hey everyone! With BlockSonic, you get the top Bitcoin news of the day in a practical narrated format, so you never miss an important market move. With BlockSonic, you don't need to search for information, we find it for you. Today, our news dives into the heart of volatility as Bitcoin braces for President Donald Trump's bold Davos address. With Bitcoin's value teetering under $90,000, the crypto world is on edge, behaving more like a tech stock than a safe haven. We'll explore how geopolitical tensions and global bond market fluctuations are shaking up the crypto landscape. In addition, we'll look at Galaxy Digital's strategic hedge fund moves and examine how luxury timepieces surprisingly defy Bitcoin's recent plunge. As Trump's speech looms, we're poised to see how his economic declarations could further influence crypto markets. Join us as we decode these turbulent times and analyze the potential ripple effects on risk assets globally. Stay tuned for a deep dive into today's dynamic financial climate. Bitcoin braces for Trump's bold Davos address. Crypto turbulence ahead. Prepare for a Bitcoin shakeup on January 21st, 2026. As we stand on the brink of President Trump's significant address at the World Economic Forum in Davos, Bitcoin's position remains under the crucial $90,000 mark. Our digital currency has experienced recovery from its recent lows, yet it continues to reflect characteristics of a volatile tech stock rather than a stable haven asset amidst the current geopolitical climate. The recent easing of pressure within global bond markets coincided with this stabilization. In Japan, government bonds saw a rebound after a sharp sell-off, with yields on extensive duration debt decreasing following governmental calls for calm. This development has provided a necessary cushion for riskier assets, including cryptocurrencies. The CD20 index demonstrated a decline of approximately 2% over the past 24 hours, mirroring the cryptocurrency and related equities sell-off during United States trading hours on Tuesday. Meanwhile, major crypto stocks reveal less than 1% decline in pre-market trading, after experiencing a 5 to 7% drop yesterday. United States equity index futures also show a slight decrease. Contributing to this volatility is President Trump's proposition for United States control over Greenland, accompanied by new tariff threats targeting several European nations. With European leaders readying for retaliatory actions, Trump's impending address at Davos will hold significant interest for market watchers. In parallel, Mike Novogratz, Galaxy Digital CEO and co-founder, observed on social media that the rising gold price signals the United States dollar's diminishing reserve currency status at an increasing pace. Novogratz described Bitcoin's performance as unsatisfactory given persistent selling pressures. Analysts at QCP Capital noted that Bitcoin's momentum struggles to regain ground amid a declining appetite for risk across markets. Bitcoin, they argue, is currently trading more like a high beta risk asset, highly susceptible to interest rates, geopolitical developments, and cross-market volatility. Until clearer policy signals emerge, it appears the cryptocurrency market will remain reactive rather than directional. As we reflect on these dynamics, we are left to ponder: how will President Trump's Davos address influence the intricate dance of cryptocurrencies and global markets? We invite you to engage in this unfolding narrative and share your insights with us in the chat. Bitcoin climbs back amid new volatility. Crypto markets react. Bitcoin finds its footing after recent volatility, mirroring shifts in the crypto market landscape as altcoins face intensified turbulence. In the wake of a tumultuous Tuesday, the cryptocurrency landscape finds Bitcoin stabilizing. The recent sell-off saw Bitcoin dip to $87,760 before regaining its stance. Currently, Bitcoin trades around $89,000, maintaining its position within a familiar range since November 20th, except for a brief ascent to $98,000, following an optimistic start to the year. This recent dip aligns with a broader risk-averse sentiment prevalent in traditional markets. Both Nasdaq 100 and S&P 500 futures have declined by 2% since Sunday's open, marking Wall Street's most significant daily drop since October. This shift towards risk aversion has propelled gold and silver to unprecedented highs as investors seek refuge in safe assets amid rising trade tensions between the United States and the European Union. Exacerbated by the tariff threats over Greenland's ownership, the cryptocurrency market's relative scarcity of liquidity has exacerbated the altcoin sell-off, leading to $500 million worth of altcoin futures positions being liquidated over the past 24 hours. This illustrates the heightened vulnerability of altcoins to market fluctuations when compared to Bitcoin's resilience. Reflecting on these developments, we observe the intricate dance of market forces shaping the cryptocurrency terrain. Bitcoin's ability to regain stability highlights its perceived strength amid uncertainty, while altcoins remind us of the volatility inherent in this evolving market. The interplay between these dynamics invites us to ponder the future paths of digital currencies. In considering these unfolding events, we invite you to reflect with us. How do we perceive the resilience of Bitcoin amidst such volatility? And what does this suggest about the future of cryptocurrencies? Share your thoughts and join the discussion in the chat. If you believe in what we're doing and want to support BlockSonic's growth, just scan the QR code on the screen or copy the link in the video description. Every contribution makes a difference and helps us keep delivering quality, independent, and up-to-date content for you. Decoding Crypto Fortunes, Galaxy Digital's bold hedge fund move. Revolutionary hedge fund alert. Crypto and fintech dynamics unleashed. Galaxy Digital, under the astute leadership of Mike Novogratz, is charting a course with a $100 million hedge fund poised to navigate the shifting tides of the cryptocurrency and fintech landscapes. This ambitious venture, set to launch in the first quarter, seeks to capitalize on both rising and falling market movements through strategic long and short positions. Approximately 30% of the fund's resources will be dedicated to cryptocurrency tokens, while the remainder will focus on financial services, stocks, influenced by the transformative impact of digital asset technologies. Backed by family offices, affluent individuals, and institutions, Galaxy Digital is also contributing its own resources to this initiative, though the specific amount remains undisclosed. As Joe Armao, the fund's manager, elucidates, the current landscape of structural shifts, including potential interest rate reductions and the growing adoption of cryptocurrencies, creates a fertile ground for such an endeavor. Galaxy Digital's financial prowess was demonstrated with a profit exceeding $500 million in the third quarter of 2025. Novogratz's adept strategy pivoting from Galaxy's origins as a hedge fund to its current asset management role, overseeing $17 billion in assets, further underscores this venture's potential. In addition to its financial endeavors, Galaxy Digital has recently achieved a significant milestone by securing approval to enhance the power capacity of its Helios data center campus in West Texas by 830 megawatts. This development follows the completion of an extensive large load interconnection study sanctioned by Texas's electric grid operator, ERCOT. Despite these advancements, Galaxy Digital's shares experienced a decline of over 6.4% on Tuesday amidst a broader market sell-off. This development invites us to reflect on the intricate dance of market forces and the potential of cryptocurrencies and fintech to redefine financial landscapes. As we ponder the implications of Galaxy Digital's strategic maneuvers, we must ask ourselves, how will these emerging dynamics shape the future of digital finance? We encourage you to join the conversation and share your thoughts in the chat. Bitcoin's dramatic plunge amidst global uncertainty. Bitcoin's volatility intensifies as European turmoil and global tensions collide. As we navigate the unfolding landscape, we witness Bitcoin's early gains dissipate on this consequential Wednesday, reflecting broader market hesitations. The digital currency dipped below $89,000, mirroring the cautious sentiment pervading European stocks and currencies. In the United States session, Bitcoin hovered around $88,800 after a fleeting rise towards $90,000 earlier, indicating a pause after substantial selling pressure rather than a robust recovery. This pattern was echoed by major tokens, initially stabilizing only to lose momentum as the day progressed. Additional markets experienced a similar downturn during the European afternoon, with the Stoxx 600 index dropping 0.5%, marking its fourth consecutive session of losses, the worst streak since November. Financial and insurance stocks notably led this decline. Bond markets, which had previously provided some relief, also weakened as yield declines across Europe diminished. Meanwhile, United States equity futures trended lower, and gold surged another 2% to reach unprecedented highs above $4,860 an ounce, highlighting a persistent investor preference for capital protection over risk. Cryptocurrency markets initially attempted to stabilize as Japanese government bonds rebounded from earlier sharp declines, aided by official efforts to calm investor nerves. This support allowed Bitcoin to reclaim some of Tuesday's losses, though the recovery remained fragile amid continuing macroeconomic pressures. Central to this uncertainty is President Trump's escalating tension with Europe ahead of his World Economic Forum address in Davos. His threat of tariffs on European nations opposing United States interests, including the acquisition of Greenland, rekindles fears of trade disputes and volatile policy. These apprehensions have weighed on the dollar, which struggles to maintain its yearly gains, while currencies like the pound face increased pressure. Tuesday's market turbulence led to over $1 billion in liquidated leveraged crypto positions, and Wednesday's movements suggest ongoing digestion of this forced unwinding. As we reflect on this intricate dance between global tensions and cryptocurrency volatility, we ponder, in a world of unpredictability, how do we navigate the complexities of digital assets and market interdependency? Share your thoughts and join the discussion in the chat. And don't forget to subscribe to the channel, like, share with your friends, and participate in the chat. The image in this live stream is a real-time game. We're implementing new features where you can interact with the game using commands via chat. Join us. These simple actions really help the project grow and keep BlockSonic running at full speed every day. Luxury timepieces defy Bitcoin's decline. A surprising correlation. As Bitcoin wavers, luxury watches ascend, revealing unexpected financial dynamics in the crypto world. In the midst of Bitcoin's downturn, an intriguing pattern emerges as luxury watches quietly ascend in value. Over the past 6 months, Bitcoin has suffered a decline of approximately 25%, and the broader crypto landscape, including the CoinDesk 20, has experienced a fall exceeding 30%. However, according to WatchChart's data, the secondary market for luxury watches has seen a rise of around 4%, illustrating a remarkable divergence in market trends. The WatchChart's index, which meticulously tracks the secondary market prices of thousands of luxury watch references from major brands, indicates an approximate 4% increase over the last half year. This upward movement in watch prices stands in stark contrast to the steep decline observed in the crypto markets over the same period. Morgan Stanley, in collaboration with WatchCharts, has released a report suggesting that the rise in secondary watch prices signifies a stabilization rather than a resurgence of a booming market. After enduring 2 years of declining prices, the banking institution notes that downward pressure began to ease in late 2025. This shift can be attributed to the clearance of excess inventory, the diminishing necessity for forced selling, and sellers' growing reluctance to further reduce prices. Concurrently, luxury watchmakers have increased global retail prices by approximately 7% since early 2025, helping to stabilize resale values despite subdued transaction volumes. This stabilization forms a stark contrast to the dynamics observed a year earlier. In 2024, luxury watches and cryptocurrencies began to diverge for the first time since the pandemic, breaking a long-standing correlation driven by easy money and speculative excess. As Bitcoin surged on the anticipation and approval of spot exchange-traded funds, watch prices continued to decline under the weight of tighter financial conditions and waning retail speculation. The recovery in the watch market has been narrowly concentrated among brands with genuine pricing power, notably Rolex, Patek Philippe, and Audemars Piguet, while most other brands continue to trade at significant discounts. As highlighted in the report, Morgan Stanley also underscores the pivotal role played by controlled secondary channels, particularly Rolex-certified pre-owned program, which has acted as a stabilizing force, reducing volatility and supporting prices at the top tier of the market. Amid these developments, gold and silver have surged as investors channel macroeconomic stress into physical scarcity assets, with crypto conspicuously excluded from this trend. Gold has risen nearly 70% since early 2025, while silver has experienced an increase of approximately 150%, driven by tight physical supply, industrial demand, and policy-related risk, which has heightened volatility in the metals markets. This divergence suggests that investors no longer view cryptocurrencies, luxury watches, and metals as interchangeable investments. Instead, they are increasingly distinguishing between rapidly evolving financial assets and more stable physical stores of scarcity as macroeconomic pressures intensify. In this intricate interplay between digital and tangible assets, we are prompted to reflect on the evolving nature of investment choices. As traditional and digital markets chart their divergent paths, how do we perceive the future of value preservation and wealth accumulation in these distinct yet interconnected domains? We invite you to share your insights and join the conversation in the chat. Bitcoin and crypto assets plummet amid global turmoil. Cryptocurrency markets face a dramatic downturn as geopolitical tensions and financial upheaval in traditional markets rattle investor confidence. In a world where every economic move resonates across the digital landscape, we found ourselves witnessing a notable downturn in cryptocurrency markets. Major digital assets experienced sharp declines as geopolitical tensions and financial market stress triggered a shift from risk-taking to capital protection. This turbulence pulled Bitcoin below the $90,000 threshold, signaling broader impacts. Bitcoin, descending below $90,000, marked a 3% decline over 24 hours, setting a precedent for losses in the cryptosphere. Ethereum experienced a 6.5% fall to below $3,000, while Solana dropped over 4% for the day and 12% for the week. Cardano followed suit, losing 2% in one day and 15% over the week, highlighting the severe impact on higher volatility tokens as traders adjusted their risk profiles. These market movements coincided with Wall Street's most challenging session since April. This came on the heels of former President Donald Trump threatening tariffs on European nations, rejecting his proposal concerning Greenland, driving down U.S. stocks, treasuries, and the dollar. In recent days, Trump advocated for U.S. acquisition of Greenland, warning of potential trade tariffs for European countries opposing the move, citing strategic concerns over Russia and China's influence in the Arctic. This rhetoric fueled fears of trade conflicts and policy instability, unsettling investors, increasing bond yields, and prompting traders to reduce exposure to riskier assets like Bitcoin, which still behaves like a high beta asset under stress. Altcoins, typically more sensitive to changes in risk appetite, led the decline as traders moved away from high volatility assets. Bitcoin, often the initial point of entry and exit for crypto risk, followed the downward trend as leveraged positions unwound. CoinGlass data revealed over $1.09 billion in crypto positions were liquidated in the past 24 hours, with nearly 92% linked to long positions. This underscores how crowded the bullish positioning had become before the downturn. The macroeconomic backdrop played a crucial role in this sell-off. Trump's tariff threats coincided with an unexpected sell-off in Japanese government bonds, where long-dated yields surged to unprecedented levels due to fiscal sustainability concerns. This shockwave rippled through global bond markets, lifting U.S. yields and tightening financial conditions. When bonds experience sharp sell-offs, borrowing costs rise, diminishing the appeal of speculative trades. This is significant for crypto, which is perceived as a high-risk asset during stress periods. As yields rise and volatility increases, investors tend to withdraw from assets with weaker cash flows or unclear short-term prospects. Gold's ascent to new all-time highs mirrored this trend, as investors flock to traditional safe havens, indicating a broader retreat from risk rather than a targeted asset reallocation. Traders had previously dismissed political noise, relying on strong liquidity and artificial intelligence enthusiasm to propel markets forward. Tuesday's events suggested diminishing tolerance for fresh shocks. The combination of trade threats, European tensions, and bond market instability disrupted the calm. For crypto markets, this episode underscored the significance of global politics and bond markets, particularly when positioning is overcrowded and volatility suppressed. As Trump heads to Davos, investors remain vigilant for potential repercussions in rates and currencies. Crypto traders now ponder whether this marks a brief reset or the onset of a more defensive phase for this volatile market. In light of these developments, we must ask, are we witnessing a transient adjustment or a fundamental shift in the landscape for cryptocurrencies? Share your thoughts and engage in the conversation with us in the chat. And don't forget to subscribe to the channel, share with your friends, and participate in the chat. The image in this live stream is a real-time game. We're implementing new features where you can interact with the game using commands via chat. Join us. These simple actions really help the project grow and keep BlockSonic running at full speed every day. Bitcoin's Plunge, $1 billion crypto crisis unveiled. A staggering 92% of the $1.09 billion liquidations were from long bets, showing traders high expectations of Bitcoin's gains before the dramatic downturn. Bitcoin's value dropped below $90,000 on Tuesday, as a significant shift in global risk sentiment triggered a dramatic wave of forced selling across the cryptocurrency markets. This event led to the liquidation of over $1 billion in leveraged, bullish bets. Drawing from data, it is observed that 183,066 traders faced liquidations over the past 24 hours, with the total reaching $1.09 billion. Long positions comprised nearly 92% of this, underscoring the extent of traders' optimism for continued gains. The largest individual liquidation was a $13.52 million Bitcoin Austerity order on BitCheck. Liquidation occurs when an exchange forcibly closes a trader's leveraged position due to a partial or total loss of the trader's initial margin. This situation arises when a trader cannot meet the margin requirements for a leveraged position, lacking sufficient funds to maintain the trade. A cascade of liquidations often signals market extremes, where a price reversal might be imminent due to market sentiment swinging excessively in one direction. Bitcoin declined by as much as 3% during the shift, plummeting to as low as $87,800 in late United States trading hours before climbing above $89,000 during Asia morning hours. This pullback signals a shift from last week's consolidation near recent highs. The sell-off occurred as broader financial markets turned cautious. Former President Donald Trump's renewed threat to impose tariffs on European nations, rejecting his Greenland proposal, unsettled investors, rekindling concerns about trade tensions and policy unpredictability. Simultaneously, a sell-off in Japanese government bonds added pressure, elevating global yields and tightening financial conditions. These cross-currents have broadly impacted risk assets, especially following an extended rally driven by enthusiasm around artificial intelligence, which propelled global equity markets to record levels. With market positions stretched and volatility compressed, cryptocurrency markets proved vulnerable once sentiment faltered. In reflecting upon these developments, we must consider the delicate balance of expectations and realities within the cryptocurrency domain. As traders, investors, and observers of this intricate market, how do we navigate the interplay between optimism and caution, particularly in the face of such dramatic shifts? We invite you to share your perspectives and insights in the chat, fostering a deeper understanding of this dynamic landscape. Bitcoin's quietude amidst gold's meteoric rise. A crypto conundrum. Cryptocurrency faces new challenges as Bitcoin stagnates, gold shines bright. As we delve into the complexities of the crypto landscape, a remarkable divergence unfolds between Bitcoin and gold. Amidst global financial tensions, gold has surged to historic heights while Bitcoin remains relatively placid. This dichotomy raises critical questions about the evolving nature of these assets within the market. In the midst of bustling Asian markets, Bitcoin finds itself hovering below $89,000, experiencing a nearly 5% decline within the day. This occurs against the backdrop of geopolitical uncertainties and a downturn in bond markets. Meanwhile, precious metals are witnessing one of the most significant rallies in decades, with gold and silver leading the charge. According to Philippe Bacassi, the chief executive officer of XBTO, this divergence is emblematic of Bitcoin's maturation. He suggests that Bitcoin, now deeply entrenched in institutional portfolios, no longer behaves like a speculative frontier asset. Instead, its narrative is solidifying, marking a departure from the venture-style volatility of its earlier years. Bacassi explains that the market has transitioned beyond Bitcoin's initial explosive growth phase. In this new era, stability, liquidity, and risk management take precedence over raw, speculative gains. Institutional investors, through regulated vehicles and corporate treasuries, are absorbing Bitcoin supply, leading to compressed volatility and more muted price movements. This shift, however, does not undermine Bitcoin's long-term potential. Bacassi emphasizes that demand remains a key driver, fueled by growing institutional inflows, and a fixed Bitcoin supply that anchors its long-term valuation despite subdued short-term dynamics. In contrast, gold's resurgence is seen as a cyclical rotation of capital. As macroeconomic stress escalates, investors with substantial Bitcoin holdings are reallocating to gold, the traditional safe haven. Gold, Bacassi observes, continues to serve as the world's refuge currency, especially for entities like governments and central banks that require immediate liquidity. The critical insight here is that Bitcoin and gold are not in competition, but serve different roles within an investment portfolio. While gold addresses immediate macroeconomic concerns, Bitcoin is increasingly viewed as a strategic asset on balance sheets, its value proposition unfolding over extended periods. Yet, Bikatsi warns of potential disruptions to this paradigm. Should Bitcoin begin to mirror high beta technology assets during inflationary or crisis periods, the narrative of digital gold could falter. Similarly, significant ETF outflows or rising prices without corresponding on-chain activity could indicate speculative rather than utilitarian demand. In the current market climate, Bitcoin's relative stability is being tested. As gold absorbs the brunt of macroeconomic stress, Bitcoin's future path will determine if its calmness reflects maturation or mispricing within the broader cycle. As we navigate these market dynamics, the question arises: will Bitcoin's quietude amid gold's rise signify an evolving maturity, or are we witnessing a fundamental misalignment in its perceived value? We invite you to share your perspectives and engage in this discourse with us in the chat. And don't forget to subscribe to the channel, like, share with your friends, and participate in the chat. The image in this live stream is a real-time game. We're implementing new features where you can interact with the game using commands via chat. Join us! These simple actions really help the project grow and keep BlockSonic running at full speed every day. Crypto's true goldmine. Bitcoin's core value mapped. Discover the hidden value. Bitcoin's role in the crypto ecosystem unveiled. A recent analysis by the Center for Financial Research at Schwab unveils a compelling framework for understanding the cryptocurrency landscape, emphasizing the crucial role of foundational blockchains like Bitcoin. This report divides the crypto world into 3 distinct layers, revealing that the majority of value resides at the core, challenging investors to rethink their approach in this dynamic space. In our exploration, we find that the report categorizes the crypto market into 3 layers, with foundational networks such as Bitcoin and Ethereum serving as the base. These essential blockchains are responsible for processing and recording transactions, forming the bedrock upon which nearly all other crypto applications rest. Schwab's findings indicate these foundational networks represented an overwhelming 80% of the total crypto market capitalization, which stood at $3.2 trillion by the close of 2025. The second layer consists of infrastructure encompassing software that interlinks blockchains and applications. This includes oracles for external data integration, bridges for asset transfer between blockchains, and scaling tools for transaction acceleration. Despite their significance, Schwab highlights the challenging business model these protocols face, as users typically do not interact with them directly, making them susceptible to replacement by new competitors. At the pinnacle of products, which include exchanges, lending platforms, and staking services, among others. These tools engage users directly, often resulting in more loyal clientele, higher switching costs, and greater potential for becoming industry standards. Schwab points to protocols such as Aave for crypto lending and Lido for staking as exemplars, while refraining from making specific investment recommendations. To further elucidate, Schwab draws parallels between the crypto sector and the traditional software industry. Foundational networks resemble cloud computing platforms like AWS or Microsoft Azure, providing the base for further development. In contrast, products are akin to direct user engagement platforms like Salesforce or Netflix. Infrastructure software, although indispensable, frequently finds itself distanced from customers, thus lacking loyalty and pricing power. The report introduces an evaluative framework for cryptocurrencies, borrowing from growth equity investment strategies. Schwab advises analyzing protocols through 4 criteria: network effects, market share, scalability, and tokenomics, which encompasses factors such as token distribution, reward mechanisms, and supply management. Ethereum serves as a case study within this analysis, dominating the smart contract domain. With over 10 times the market share of its nearest competitor, Ethereum's ecosystem, measured by total value locked, demonstrates its strong network effect due to early adoption and widespread developer use. However, Schwab raises concerns about Ethereum's slower transaction speeds and concentrated ownership. A significant insight from the report is the struggle of infrastructure protocols to retain value, despite their critical role. Among projects with market caps exceeding $100 million, product protocols are nearly twice as prevalent as infrastructure ones. Yet, foundational networks, though fewer, hold a substantial portion of the market's total value. Schwab underscores the speculative and high-risk nature of cryptocurrencies. For those venturing into this market, the report advises against simply buying crypto. Instead, a deep understanding of where value truly resides is essential. In Schwab's assessment, the value is likely concentrated within the foundational networks and the everyday tools that people engage with. As we ponder these insights, a profound question arises. How can we, as investors and enthusiasts, align our strategies to truly capture the intrinsic value within the cryptocurrency ecosystem? We invite you to share your thoughts and join the conversation in the chat. Cryptocurrency and the golden surge, a $5,000 target? The meteoric rise of gold-backed cryptocurrencies is capturing investor interest as they outpace most gold ETFs, with a new target of $5,000 on the horizon. The recent surge in gold's value, which saw an impressive 70% rally in a single year, has invigorated investor interest, with tokenized gold emerging as a significant player in the market. This development is attracting both institutional and retail investors seeking a haven amid geopolitical uncertainties and fluctuating trade policies. Crypto tokens like ZOT and Paxos Gold, PaxG, have experienced massive growth, as reported by crypto exchange Sexio, surpassing the trading volumes of most traditional gold exchange-traded funds, ETFs. Tokenized gold trading volumes reached $178 billion in 2025, with $126 billion traded in the final quarter alone. This figure places tokenized gold ahead of all but one United States-listed ETF, namely the SDR Gold Shares, GLD, which holds $165 billion in assets under management. The report suggests that if tokenized gold were categorized as an ETF, it would rank as the second largest by trading volume globally. However, the market remains concentrated, with Tether's XOT accounting for 75% of the fourth quarter trading volume. The market capitalization for tokenized gold also experienced a significant increase, surging by 177% to surpass $4.4 billion. Despite this growth, tokenized gold remains a small player compared to the total gold market, valued at $32 trillion. Retail demand plays a crucial role in the growth of tokenized gold, as these tokens offer fractional ownership and no minimum investment requirements, making them accessible to a broader range of investors. This is particularly relevant in emerging markets, where traditional gold-linked investment products may not be readily available. As gold's value reached $4,750 on Tuesday, marking a nearly 10% increase since the year began. Gracie Chen, the CEO of crypto exchange Bitget, expressed optimism about gold reaching the $5,000 mark. She noted that with tariffs coming back into focus, capital is likely to shift toward defensive assets, with gold taking the lead. Chen emphasized that if current conditions persist, the $5,000 target is within reach. As we reflect on this unfolding narrative, we see a fascinating interplay between traditional assets and their digital counterparts. The question that arises is, in a world where geopolitical tensions and market volatility prevail, will tokenized assets continue to redefine how we perceive and invest in traditional commodities? We invite you to share your thoughts and participate in the discussion in the chat. And don't forget to subscribe to the channel, like, share with your friends, and participate in the chat. The image in this live stream is a real-time game. We're implementing new features where you can interact with the game using commands via chat. Join us! These simple actions really help the project grow and keep BlockSonic running at full speed every day. Bitcoin Bonanza. Trump Media's bold crypto airdrop strategy. Trump Media's blockchain rewards initiative sees a major boost with the introduction of digital tokens for DJT shareholders, intertwining Bitcoin's allure with innovative shareholder engagement. As stewards of economic innovation, we observe Trump Media and Technology Group, trading under NASDAQ and New York Stock Exchange, Texas. DJT, preparing to issue digital tokens to its shareholders. Those holding at least one full share by February 2nd will be eligible, marking a significant step in integrating blockchain architecture within their media and financial technology ecosystem. This strategy, foreshadowed late last year, aims to enhance engagement through token rewards. Amid inquiries about the necessity of commission approval for the airdrop, Shannon Devine, the spokesperson for Trump Media, clarified that they are adhering to public guidance. Devine emphasized that the tokens are not securities, as they do not confer ownership or profit expectations from managerial efforts. Instead, they anticipate offering periodic rewards to shareholders, potentially including benefits linked to their platforms, such as Truth Social, Truth Plus, and the forthcoming Truth Predict. Crypto.com will mint and hold these tokens until distributed. They hold no equity, cannot be traded, and are not cash redeemable. Eligible shareholders may receive non-financial perks tied to offerings like Truth Social and the gamified Truth Predict. Trump Media advises shareholders to verify their non-objecting beneficial owner status to avoid delays in token reception. Chief Executive Officer Devin Nunes noted the initiative's alignment with Securities and Exchange Commission guidance, leveraging Crypto.com's infrastructure to ensure transparency and confirm rightful ownership at the snapshot's moment. While the tokens lack investment value, this venture represents an innovative experiment in blockchain-driven shareholder engagement. It aligns with Trump Media's push into digital finance through Truth, promoting America First investment products under World Liberty Financial. Further details on distribution and incentives will follow the February 2nd record date. Reflecting on these developments, we see a fascinating interplay between blockchain potential and shareholder engagement. This move could redefine participation in corporate ecosystems, offering a glimpse into a future where digital assets create new forms of value. As we contemplate this intersection of traditional finance and blockchain innovation, we ask, how might these digital tokens reshape shareholder engagement and influence the broader adoption of cryptocurrencies like Bitcoin? Share your insights and join the discussion. Bitcoin's dramatic plunge. A crypto storm brewing. Bitcoin's value plummets amid tariff tensions and market turmoil. Crypto analysts weigh in. We find ourselves observing a notable decline in Bitcoin's value, which has dipped below $89,000 as global markets react to emerging geopolitical tensions. The interplay of factors affecting cryptocurrencies has been accentuated by a sell-off in Japan's bond market and escalating tariff threats from the United States administration. This unfolding scenario provides a vivid illustration of the complex factors influencing digital assets like Bitcoin. As Bitcoin falls below $90,000, we witness market participants hastily offloading risk assets, prompting a reassessment of Bitcoin's trajectory for the year. The anticipation of a bullish market is tempered by these developments, and the cryptocurrency's gains since the year's start are now precariously positioned. Notably, earlier speculation of Bitcoin reaching $100,000 seems overshadowed by the current bearish sentiment, as some experts predict a potential drop to between $58,000 and $62,000 within weeks. Meanwhile, options data suggests a 30% probability of Bitcoin falling below $80,000 by June's end. In this turbulent crypto landscape, Bitcoin's price hovers around $88,403, and Ethereum remains under $3,000. The Asian trading session has added to the volatility, with Bitcoin reaching levels last seen on January 2nd of this year. The market's mood is reflected in the Crypto Fear and Greed Index, which has dipped to 31, signaling heightened trader apprehension. During the day's trading, Bitcoin stabilized around $89,700, showing a 3.6% decline over 24 hours, its sharpest daily drop since early December. Ethereum held just below $3,000, while broader market indices such as the CoinDesk 20 index fell over 5%. Some cryptocurrencies, including Monero and Dash, experienced losses exceeding 10%. The decline in crypto assets paralleled a downturn in traditional markets, with major indices such as the S&P 500 and NASDAQ 100 experiencing over 2% declines. Notably, crypto-linked stocks like Strategy, Bitmine Immersion, and Coinbase saw significant drops, highlighting the interconnectedness of these markets. Amidst this financial tumult, BitMEX co-founder Arthur Hayes expressed concern over the potential spillover of Japan's bond market volatility into U.S. Treasuries. He warned of a potential bailout scenario, as indicated by a spike in the MOVE index, a key volatility measure for Treasury bonds. In the broader economic context, figures like Novogratz highlighted the deteriorating U.S. reserve currency status and suggested that Bitcoin must surpass $100,000 to regain its upward momentum. As we reflect on these developments, we recognize the intricate web of influences that shape the crypto market. The volatility we observe serves as a reminder of the dynamic nature of digital assets and their susceptibility to broader economic and geopolitical forces. How do these unfolding events impact your perception of Bitcoin and the broader cryptocurrency market? We invite you to share your thoughts and engage in this ongoing conversation in the chat. Crypto Revolution, new CFTC. Chief Selig's bold move for Bitcoin's future. CFTC Chief Mike Selig unveils a daring plan to solidify Bitcoin policy, promising unshakable rules that secure the future of crypto. Mike Selig, newly appointed leader of the United States Commodity Futures Trading Commission, stands poised to redefine crypto market regulation with an ambitious rulemaking strategy designed to future-proof the oversight of dynamic financial technologies. While Selig's Tuesday announcement of a new course lacked specific regulatory details, the chairman appointed by President Donald Trump signaled a warning to traditional financial entities. They must adapt to compete with a fresh wave of entrants into United States finance who will operate under customized regulations. In the coming days, we will disclose further policy adaptations, Selig expressed in a series of declarations on social media platform X, coinciding with an editorial in the Washington Post. His strategy, following a year-long pro-crypto endeavor by former acting chairman Caroline Pham, aims to protect emerging policies from rogue regulators. We will cease regulation by enforcement, ensuring new markets thrive domestically with bespoke regulations that maintain American markets as the global pinnacle, he stated. Acknowledging the digital asset economy has evolved from a mere curiosity to a $3 trillion market. Selig, who announced a secondary initiative to establish an innovation advisory committee to guide this mission, also mentioned other financial innovation sectors, including prediction markets and perpetual futures. The same drive that propelled American pioneers to cultivate the Great Plains now inspires today's innovators to depart traditional finance and explore uncharted territories, Selig remarked. They are harnessing technologies like blockchain to rejuvenate legacy financial systems and construct entirely novel frameworks. Although he did not discuss ongoing legislative efforts in the United States Congress to enact new crypto legislation, he highlighted the rigorous rulemaking process that would resist reversal by future agency leaders. In contrast to Trump's regulatory allies, who have nullified previous informal guidance from Biden-era federal bodies. The agency additionally revealed that Selig had secured the expertise of external crypto attorney Michael Passalacqua to bolster the initiative. Passalacqua began his legal journey at crypto exchange CrossTower, which ceased operations some years ago, before engaging in digital asset-focused practice at two notable law firms. When Trump encountered challenges in securing a Senate-confirmed CFTC leader last year, abandoning his initial choice, former Commissioner Brian Quintenz, Pham managed the agency during the first year of his tenure. Pham prioritized crypto policy, departing the agency last month to join crypto entity MoonPay, and initiated several efforts including close collaboration with the Securities and Exchange Commission for cohesive digital asset regulation. As we reflect on the unfolding dynamics of crypto regulation, we must ponder, are these tailored rules the key to unlocking the full potential of Bitcoin within the American financial landscape? We invite you to engage with us in the chat and share your insights. Crypto market faces turbulence. Solana's wild ride amid $350.0 million liquidations. In a dramatic turn, Solana dips and rebounds as the crypto world witnesses massive liquidations impacting Bitcoin and altcoins alike, with uncertainty looming large. The cryptocurrency landscape has witnessed significant volatility, with Solana experiencing a notable decline in value to $127.40. Nearly 4% down in the past 24 hours from its recent high, close to $145. This downturn followed a cascade of liquidations within the derivatives market and a widespread weakening of alternative cryptocurrencies. Nearly $390 million in crypto positions were liquidated, with $348 million being long positions, according to recent data. The sell-off gained momentum as Solana breached its 20-day and 50-day exponential moving averages. Volume surged dramatically during the decline, with one hourly spike featuring 3 million Solana traded, over 200% above the 24-hour average. Despite strong fundamentals, including approximately $15 billion in stablecoins circulating within the Solana network and over $1 billion in tokenized real-world assets, technical signals indicate growing uncertainty. Solana now trades below a crucial ascending trendline and hovers near multi-week support at $128. Analysts remain divided on the forecast. Some view the decline as a temporary shakeout, potentially attracting new buyers, while others warn of a possible deeper descent towards $122 or even lower. Recent net outflows from Solana exchange-traded funds and a broader risk-off sentiment driven by geopolitical tensions and macroeconomic uncertainties further exacerbate the situation. Currently, the $128 to $130 range serves as the critical zone of contention. A decisive break below this range could signal a prolonged downtrend. As we observe these market dynamics, we must consider the interplay of technical indicators and market sentiments. The resilience of Solana and other cryptocurrencies amidst such fluctuations raises important questions about the future trajectory of crypto assets. How do you perceive the recent movements in Solana and the broader crypto market? We invite you to share your insights and join the conversation in the chat. Bitcoin descends below $90,000 as risk assets tumble globally. Ether suffers heavy losses amid crypto market turmoil, dipping below $3,000. In a climate of heightened market anxiety, Bitcoin experienced a descent of 3%, sinking below $90,000 during the morning trading hours in the United States on a recent Tuesday. This movement followed a disruption in Japan's bond market, compounded by ongoing tariff threats from the United States directed at Europe, which collectively pressured risk assets downward. Ether, a native cryptocurrency of the Ethereum network, faced a sharper decline, plummeting over 7% within a 24-hour period. This drop brought its value below the critical $3,000 threshold, a level it had maintained since January 2nd. Throughout this turbulence, a notable shift in market dynamics emerged as Bitcoin's dominance within the crypto market continued to ascend. The Bitcoin dominance metric, indicating the largest cryptocurrency's share of the total digital asset market capitalization, reached 59.8% on Tuesday, as per TradingView data. Paul Howard, of trading firm Winsent, remarked in a note that volatility has returned, and in alignment with risk assets, we anticipate Bitcoin to continue its downward trajectory, with altcoins likely bearing the brunt of the impact in the short term. On the same day, the Nasdaq index experienced a near 2% drop. Japan's Nikkei index fell 2.5% overnight, while Germany's DAX saw a 1% decline. Conversely, precious metals shone brightly as a favored safe haven, with gold soaring by 3% and silver by 7%. Both reaching new record highs. As Bitcoin's value decreases today, it relinquishes much of the gains accrued in the year 2026, now standing just 3% above its level at the start of the year. In reflecting on this scenario, we must ponder the resilience of cryptocurrencies amidst global economic uncertainties. Can Bitcoin and its counterparts withstand the pressures of traditional market dynamics and emerge stronger? We invite you to share your insights and join the conversation in the chat. Thank you so much for following BlockSonic today. See you in the next live session with more news, analysis, and market alerts. Don't forget to follow our channel and turn on notifications. See you soon. Keep an eye on Bitcoin and continue listening to the sound of the blockchain.